average of the PE. That is because it's very difficult to estimate what is the right PE, because it depends on so many factors, and person to person they can justify different type of PE depending on the risk they see in the market and the return they expect. So in lieu of that, we decided that no, we'll go with what has been in the past, and one such metric that we used was the PE ratio. Today we will also look at the another ratio, which is the price to book value, which is mostly used for banks. But before we go to that topic, let us look at the PE interest rate. How does it get affected? See, there are PE is generally affected by certain macro developments also, and those macro developments finally reflect in terms of the interest rates and liquidity. So we have seen that over a period of time, the P ratio of the Indian market has moved up. Now that we have shown even in the Excel spreadsheet. Let me say, okay, and okay, so I made the font bigger, and probably this is more viewable for you now. See what happened until 2009. You know, the general average PE, if you look at it from 2000 to 2009. We saw the average PE working out to 17.8, and that's a time when we had higher interest rate. Now, say for example, most of the time the interest rates were an upward of 8%, and even in 2013-14, when the rupee was depreciating, we had very high interest rate scenario, and that is why we see in 2013 also, if you look at the average, PE, when the interest rates were even higher, which was approximately 7.5 to 8.5%. That was the repo rate. There itself we were at 17.75. So at a very high interest rate scenario also, we were at 17.75. Now, if you're talking about a 21 PE, look at the interest rate is not 8.5%, 8.5% repo rate. Repo rate is 5.5%. Repo rate is now 5.5%. And also the long-term yield, that is the 10-year GSEC yield, is approximately 7.25%. Now, that point of time, when the short-term interest rate itself is around 7%, the GSEC was even slightly more. So it was at least 2% more than the present PE. So when we look at this, that from 17.5 to right now, which is around this 21.5%. So there is a 3% gap. 3% gap. For approximately 3% gap works out something like 20% or so, for an interest rate difference of at least 2%. Okay, at least so that means if you see that there is a 10% shift in PE for approximately 1% interest rate. So this is how we normally use the impact to look at the impact of the interest rates in the stock market. Now, see in the 2013. The repo rate was anything between 7.5 to 8.5%, and now it's 5.5%. So there is a 2% approximately, on an average 2% it's down, and the PE is now shifted from 71.5 to 21.5. So there is a shift of 4% increase in the PE, which in percentage terms come around approximately to 20 to 25%. So for every 1% move in this, it reflects around 10% change in PE. 10% change in PE, and this has been correlated, with respect to US stock market, with respect to the US 10-year yield. If you look at the US 10-year yield, generally they say the strong correlation that exists. They do a regression analysis, and it is given, one of the regression analysis says it's 0.55 into 10-year treasury yield plus 3.23%. Now, this is the treasury yield is now say 2.8. So 2.8 into approximately 1.4 plus 3.23, which is 4.63, and this is what they call as a earnings yield. So we have already described that 1 by PE, that is called the earnings yield. in one of the webinars we have explained what is the earnings yield. So in the case of treasury paper, when you hold the paper, they call it as YTM, yield to maturity. That means if you hold that particular paper till the maturity of the particular paper, then the realization that you get, the net yield that you get, is what is called as a YTM. So if you say the GSEC YTM is around 7.25%, that means if you hold Government of India paper for 10 years, on maturity at the end of 10 years, with respect to all the coupons that you have collected, and then with the difference between the present value at which you bought and the face value of the treasury paper, the net, if you add up all this, sum up all these things and look at the entire cash flow, you will get something like a 7.25% 10-year yield. So when you're talking about that, in the US, the present treasury yield is 2.75%. Let us say 2.75%. Now, the US PE is now going at around say 21. I don't know exactly 21 or 22, but approximately this. So the earnings yield is 1 by PE, which is what we explained right now here. So 1 by 21. So 1 by 21 is 4.75%. 4 points. So the earnings yield in US stock market, broad stock market, is 4.75%, whereas the government yield is only 2.75%. So which is more attractive? This is more attractive, right? So the investment normally when the equity market, it looks at the overall picture. And when you say 2.75% for the PE in US market and 4.75% the earnings yield, then it becomes quite attractive, right? So normally what happens is that once it's very attractive, then generally there is more and more lucrativeness towards going into the stock market. And that is the reason why we have seen that in the flow of funds in US markets, in US equities, is much greater, and also the equity culture is better, mainly because of the huge difference between the yield that you get in a risk-free market and then the earnings yield that you get there. In India, it is the opposite, but we have to look at the tax difference and all. So let us say the what could be the appropriate P? What could be an appropriate P? Now, normally P is looked at from the stocks which comprise the Nifty index, and then the weightage that is given to it, and then you justify the P for each of that particular stock, and then look at the valuation. So that is one way of looking at it. The second way that you can look at it is, see the the proportion of the total cumulative 50 stocks, what it should be the PE, can be judged in terms of reference to the interest rate scenario. Now, technically speaking, if in the US market the government the US Treasury yield is 2.75%, then even a PE which is 1 divided by 2.75 will be considered still as acceptable. That is 36. At this rate, even a 36 PE can be considered as something which is fair. I am not saying that it should go to that. I am saying that it is considered fair. So if it comes to 36 PE, then in that case it loses its attractiveness, because the earnings yield matches that government security yield, and this is a credit risk-free market. This is a market where it could have the price risk. So the advantage will then tilt towards that. So it can go right up to 36, but it will not go up to 36, right? So that is the way you look at what could be up to a fair valuation in the market. Now you adjust for the risk that needs to be there. Now you adjust for the risk that is there in the market. Okay, so what is the return that you get in the equity market there? So when you get this, let us say you get a 36% earnings yield that you get. Okay, so what is the risk factor that you take there? What is the risk premium that you attach is what we have to look at it, right? So the risk premium that you attach in the as far as the equity markets compared to the treasury paper probably can be said to be around 5%, generally speaking, but it's not 5%. Generally it's more, because the return in the equity markets there is on 13, 14, 15%, right? So if you look at that and deduct that particular percentage, which is 12, 13%, then normally it can go 24 PE, is something which is acceptable. 23, 24 PE is acceptable. So this is how you look at the justification for the PE in terms of the treasury yield. There are regression analysis which have been done, and those regression analysis also, that's what I put it initially. That is the 0.55 into treasury yield plus 3.2. This is one of the equations which is there, and is also monitored by Fed in order to know whether there is a bubble in the market, or in what way the valuation compared to the macroeconomic trends. So based on that, they look at it. So any PE which goes right in the equity market there can be justified. If it is 2.75%, it can be justified up to 36%. Up to 36%. But considering the risk that you have, okay, and no, so normally what they do is at least you get a 2.75% if it is there. Then at least you put some 2% here in the government this one yield. So you get something like 4.75%, and you take this. So this is how the US market works. Now Indian market, as I told you previously, we are very strongly correlated with the US markets. So we rise or fall along with the US market in a very substantial. The correlation is very high. So that means there whatever happens, probably if you look at the S&P, the PE ratio, more or less we are matching. I will not say exactly point to point, but right now if you look at the PE ratio here, PE ratio there, more or less it's the same, okay, around this 21 levels. So in the US markets, also the last 10 years or 5 years, if you look at it, generally it's around median level could be around 18, 19 or so. It's slightly, Indian markets are always slightly more pricey compared to the US markets, and that is because of certain other factors. Now when you look at the Indian market, so the factors, that could be because of the promoters holding, taxation differences, all those things, dollar rupee appreciation, depreciation, so all those things can be there. But the if you look at from the Indian point of view, it will look as if it is a little the same equation will look to be slightly topsy-turvy. Now for example, if you use the Indian GSEC, if you is, let us look at the GSEC as well as we look at the repo rate. So let us say we use the repo rate first here, which is the short-term rates. But the short-term rates generally, if it's rolled over, it becomes a long-term rate, right? So the repo rate, let us say it's 5.4%, and bank interest rate, or you take the FD, okay. Normally, you go to any bank for that matter, senior, most of the top PSU banks which are don't have that much of credit risk, generally offer something an FD of say 6%. Generally offer an FD of 6%. So let's take this value for 5.4 or 6%. Now, so there is a difference in the equity market and FD as far as taxation is concerned, right? So taxation generally is around, if you're at the high tax bracket, you end up paying 30% here, 30% plus. In the equity markets, above 1 lakh, you pay capital gains tax is only 10%. So let me say some 20% is further deducted for the differential. Then even the 6% minus 20%, right, comes to 1.2, which is 4.8. So the earnings yield in terms of the PE, this 1 by 4.8 translates into 1 divided by 4.8. It translates to 21 PE. It translates. So that is where the Indian PE is right now. So if you look at this, from the US standpoint of view, then we also should be slightly, getting a little more than the treasury yield, which means for the risk that we are taking, we should be plus 2. It should be 6.8. So 1 divided by 6.8. So we should, if you exactly look at the market there, then an Indian PE of only 15 could be justified because of the high inflation, high interest rate. Because we are having a interest rate much higher than US market, right? We are having an interest rate which is higher than the US market. But then also because of the dollar rupee factor, because you can easily argue that we are this is 2.75% and that is we are at 7.5%. but that is a different currency, and we are a different currency. Okay, so when we look at that, then the 7.5, 7.2 or 7.3% that we have here, if you want to compare with the market there, then we should deduct straight away 7.3 minus 3, 4.3%. So this is the treasury yield. Probably, when you're looking at edging this market, 3, or it could be slightly more. So 1 divided by 4.3 as far as the treasury paper is concerned. If you look at that, then this is the difference between the US yield of 2.75, and if it is a free market, if it's a market is quite free, then in that case there looks to be an arbitrage between 2.75 and 4.3 here, right? So even if you're assuming this 1 divided by 4.3, so in that case it comes to 23 PE. Okay, so this is nothing wrong. There is nothing wrong in this, and so this 4.3. Suppose if you add another 2% for the risk that we are taking here, so 7.3, 4.3 plus 2, it should be then 6.3. So 1 divided by 6, around 17 P, 16 to 17 P. So this is a very justified P. I mean, I would say that this P of Indian markets should command something is around 17 PE for the after we account for all the differentials and other things. Otherwise, we have to simply go with what the US market thing is, considering that there is no arbitrage. There is no arbitrage in that. So we should look at that from that point of view and say that even the Indian yield is quite attractive after looking at the dollar rupee scenario, because what we are trying to do is that we are trying to, when you say US market, when you say Indian market, both should be equalized, right? So when you say equalized, then in that case, no, we should be putting our dollar rupee forward difference, all those things. With that, we can justify this. But nevertheless, if you take a short-term repo rate of 5.5, 5.4% or 6% FD, and then for the taxation difference that if you do, then this particular PE is quite justified. But if you still want to put a risk premium to that, then the PE can shrink as much to 15 to 17 as far as India is concerned, but practically it does not happen. Since we are correlated with the US stock market, I think we are also correlated in terms of all other parameters as far as the rise and gain, the PE. Then we are forced to use the same amount of GSEC, normalize it for the Indian market and use it. So that is how we have this PE as far as the US market is justified, and so is the case with the Indian market. So what happens if the interest rates go up? So when the interest rates go up, we have already highlighted that in the 2013 period, we were at a repo rate of 8.5, and today we are at a repo rate of 5.4. That means, okay, you take for the average could have been 7.5 to 8.5, and now it's around 5.5. So there's a 2% difference. For a 2% difference, there is a difference of something like 25%. So that means 10% approximately for every percentage increased interest rate it happens. So what happens if the if the interest rates are going to be hiked further from 5.4 to 6.4, assuming it happens, then for every 1%, I told you 10% drop could be possible. So in that particular case, we can look at a scenario of the Indian PE coming closer to the 18 to approximately an 18 level if the repo rate goes up to 6.5%. If the repo rate goes to 6.5%, we can look at some P of 18 to 19. So the inflation factor will determine whether we are going to go towards this or we are going to stagnate around this. So it is better then in that case, in the particular case where the inflation is still not tamed, I think we should work ourselves to buying at a P at least less than 20. Okay, so that's a safe zone, less than 20. Then in that case, what happens is that then the EPS growth matters. So if you are buying at closer to 20 or less than 20, then P will stabilize around that. P will stabilize around that, or P can expand from that. So from this, then in that case, it is the EPS growth that will matter. So what is the EPS growth that is expected? It all depends on the company results. Okay, so the P could be a function of a macro reasons because of the liquidity and interest rate, but EPS is a micro function. The long-term movement of the market is predominantly dominated by the EPS growth. So if you look at 10 years, so even when we looked at from 2013, where the PE was something like 17.5 to 18%, right? So let's look at the table now. So 2013, if you look at it, we were at an average of 17.74. 17.74, and this year till now we are averaging out in 2022, we are averaging something like 21.5. So there has been a 4% increase in 9 years. So 4% in PE means approximately 25%, let us say, in this. So yeah, 3.44. So 25%. The 25% divided by almost 9 years. So that has contributed only to the extent of a 3% or 2.5 to 3% growth in the stock CAGR. So in the stock CAGR, if the price has grown, let us say, if the equity prices have grown, like let us say in the last 9 years, I don't know exactly, but I'm just saying, let us say it is 12% is there, then in that case, around 3% is contributed by PE expansion in this case, and 9% is contributed by EPS growth. So the long-term compounded profit growth in India should be only closer to this, and this is a little bit we should be looking towards other macro factors like interest rates and other things. So the major portion that is that we are EPS growth, the profit growth here for most of the companies is coming the longer term, 10 years, 9 years, 10 years. The compounded profit growth is coming 9 to 10%. Okay, so if you look at many companies, except for very high growth companies, which on a longer period could be around 13%. In a shorter period of time, 3 years, 5 years, there is a chance that probably it just grows by, say, for example, 35%, 50%, and all. So that is due to certain short-term factors that can be there. So when the short-term factors have arisen, and the 3-year growth and all is already, say, 5-year growth, 3-year growth are all coming at something like 15 to 20%. And if the long-term growth is only 10%, that means the next 3-5 years, those things may probably have a lesser profit growth in order to equalize the overall thing of something like a 10% growth. So this is what we have to keep in mind. So when you buy a stock, probably if already the compounded profit growth in the last 3 years has exceeded very high expectations, then in that case you need to be careful. Not that it will go to have an immediate fall or something like that. Maybe for 1 or 2 years it can still maintain its momentum. But if the long story is that there is no further, growth oriented approach which can increase that further. Okay, if it is a normal company where there is not much of investment into other areas of growth, and so all this profit growth and sales growth has not been there, but profit growth has come, and profit growth has come only because of certain adjustments regarding the financing way or doing things or cutting down cost. In that case, that cannot sustain for a longer period of time, so the profit thing will taper off. So you have to be careful about it. So when you pick up a growth oriented company, you should also look at whether it is still relatively undervalued compared to its long-term median. In that case, it is better. So when you pick up stocks, then you should be quite confident in your approach. Okay, for that the fundamental analysis will help. And when you're doing a Nifty, you're buying it in the futures, or you're doing it in the options, or you're doing it for investment purposes, then in that case you need to look at what is the safety margin. Now when you look at this one, I think the safety margin comes only when the PE is 20 or below. Only when the PE is 20 or below. So I would prefer a safety margin between 18 to 20. And normally in the last 5 years, the Nifty PE has not gone below 19.5. So something below 20, I think it is acceptable. Now then, what is the EPS? Now the EPS right now in the first quarter has been disappointing to the extent that they say that we have got only 187. But the projection that has been given for this year, this is the first quarter thing, and the projection that has come for the entire year is going to be something like 850. So we don't know whether this is going to be achieved. from the remaining 3 quarters, or we are going to have issues there. But suppose if it is going to be somewhere around this 850 mark, and you're going to have a 20 PE, then in that case 17,000 somewhere in this region if you buy, or something below that. So something below that, in order to get a margin, 16,500 you buy. Okay, then in that case you have been taken care of by the PE, which will not sink much, which can give a profit through expansion at some stage back to 24 or 25, and the EPS growth from here, if it is going to come, our profit growth is going to come for the next 12 to 14% if it comes in that particular range, or even 10% if it comes, and this P expands itself a little bit, then we are comfortable with the 12 to 14%. We will get that. And then you look at high beta stocks, which can give, or you look at the small and mid cap growth, PE growth. From there you can look at how things can go about it, right? So then this is a completely a macro picture right now we are given. So when we are looking at individual companies, it is difficult for us to evaluate exactly in terms of interest rate versus the PE. We have evaluated only in terms of the Nifty PE. But what we can do is that we can do a correlation study between the Nifty PE and the individual stock PE to know where the individual stock PE should be if the Nifty PE is at 20. That is one thing. I leave it to those people who are interested in doing statistical analysis. The second point that we are looking at is the same individual stock. What is the median PE? Okay, over a period of 5 years, over a period of 10 years. Also, we look at, for some stocks, we have to look at the book value. Now, the price, there are certain companies which cannot be evaluated in terms of PE, particularly when the company is not giving dividend, and also the company may be at a loss making at some stage. So in that particular case, the PE ratio will not be appropriate. Okay, particularly if the company is in the loss in that particular year. So in that case, we need to look at the price to book value. Second thing is, most of the banks are assessed more in terms of price to book value, because that is the way they can turn up their productive capacity, how much the return on assets they are able to get. That's very important. So book value is used more as a measurement for banks. So right now we will look at the price to book value, and look at whether the markets are fairly priced or whether it needs to probably go down further. Now, yesterday I think we did mention that, for example, in say Reliance. Now Reliance, the book value is around 2.2 or something like that right now. The book value is 1150 or so. So right now it's going at around 2.2 or so. The lowest that we saw in terms of book value in Reliance in the last decade or so is something like, lowest is 1.7, median is around 2 to 2.1. So that means this is fair value. So that is the way we can make a measurement. That means probably if it falls to 2, then a 10% fall from here. That means 2600 minus 10%, 300 rupees. So that is the reason why we are getting support closer to 2300. So any fall which is very closer to 2300 can be justified in case of Reliance in terms of the book value. Suppose if it's the falls further for some reason, because of some shock or a thing, then it becomes definitely a buy. So a further addition can be done. So only case that where probably we can err is that the book value itself keeps falling. So that means the book value, if it is falling, then either the liabilities are increasing very significantly than the assets. So that is the only way the book value will keep decreasing. So that we have to look at whether the assets or whether the liabilities are going to go much higher than the increase in the assets. So that will decrease the book value. But if you get a note about the general trend of that particular company, how the book value is increasing over a period of time, and in that case, we will get a confidence that book value is not dipping or dipping. Generally, it is on an upward trajectory. Then we can use this particular ratio for a clear direction of the price. Now, ICICI, for example, most of the bank stocks, particularly ICICI and HDFC Bank and all, normally over a period of 5 years and over a period of 10 years, they have a book value which is 4.2 or so. Price to book value is around 4.2. Okay, so they are look more. This is the median level for last 5 years, for last 10 years also. If you take, okay, so the right now, let us say ICA is going at 3.3. ICICI is going at 3.3. That means there is a potential for it to go up to 4. Means another 20% gain from here is possible. So if it is trading at around say less than 900, okay, so it going above 1000 or going up to 1080 is where probably we can put it if it edges towards its median book value. And that time probably it becomes a very clearly case of fair value. And right now ICICI can be classified in terms of both a growth stock, because sometimes the growth stock is something where probably there is a big expansion of the CAGR which takes place. Most of the growth companies will have generally a low dividend yield, but the investment in future prospects through investment activity keeps increasing as far as growth companies are concerned, and hence the dividend payout ratio will be lower, generally speaking will be lower. So but whereas the opposite happens as far as value investment is concerned. We will have a separate discussion on that. So in the case of value investment, generally the dividend yield is very high, but wherever if you see the dividend yield is quite high, the stock prices does not reflect the growth in the dividend yield. Generally there is always even a fall in the prices, and the general return even after taking the dividend yield is much lower. Even if the company is making good amount of compounded profit growth happens, return on equity is good, then also there is not much of a great value as far as the CAGR of the stock price is concerned. So that has got much to do with either probably we need to be patient to know that probably over a period of 5 years and 10 years there will be some realization that these stocks are too undervalued and it should be bought. One. And second factor is there could be some issues of governance which we may not know, and that is the reason why it is still languishing. Third is probably the type of holdings, promoter holdings, or it could be some PSU stocks where there not be much of an interest. So there could be some combinations like this which is not helping the stock prices to go up. But there are stocks which are value stocks, and those stocks which are trading very at a discount to their book value, and those stocks which have the potential to go up in case if certain things change. Now in that case fits the so I told you about ICICI Bank. Now I'm just going to Tata Steel. Now okay, now Tata Steel price is around 112 rupees. The book value is around 93. Okay, so the lowest price to book value that it has come is around 0.7. Is 0.7, and the median over a period of 5 years and 10 years is something like 1.9 price to book value, and right now it is around, if you look at it, is 1.2 or so, right? 1.2 or so. So that means there is a big upside awaiting Tata Steel at some stage. Almost 75 to 80% gain is completely possible as far as Tata Steel is concerned. And Tata Steel also, if you look at it, it is trading at a very low P also, around 3.5. And normally it goes up to 8 to 9 P is possible as far as Tata Steel is concerned. That means you look at almost a possibility of this going more than double, right? Here also. So Tata Steel, and also the dividend yield is quite good as far as Tata Steel is concerned. So this stock, it has corrected by approximately 50% from the peak approximately, and there has been a rally from the bottom. So let us see, the overall picture turns out to be a little more on the downside. Then in that case you keep an eye on Tata Steel, so mark for that. Now the reason why we said no, avoid commodity stocks for some time is because as the central banks fight inflation, then the entire objective is to tame the commodity prices, right, in order to bring down the inflation, and that includes both agricultural products, then it includes oil, gasoline, then it also includes industrial metals. And because of that, we will see some more targeted Fed funds rising or the Indian interest rates going up can provide some sort of a resistance to the rise in commodity prices for time being. But whenever the interest rate looks like peaking, which probably will come after a couple of months, now it is August, so by November, December, I think there's a chance that interest rates will peak and inflation can come under control. If we get that idea that inflation is coming under control and the commodity prices are likely to find a bottom, then in that case Tata Steel will offer great value because it will just beat the index performance very significantly as it did last year. And if you look at let us say Tata Steel's performance, so we'll put Tata Steel. Tata Steel. So if you look at it, the stock is providing a good dividend yield of 4.5%. Company has delivered a profit growth of 76.8% CAGR over last 5 years. 76.8% CAGR over last 5 years. It is maintaining a very healthy dividend payout of 43%. And even among its peers, this is trading at a very low PE. Even compared to SAIL, it is trading below a PE. Compared to Jindal stainless, it is slightly at that level or slightly below that. And let's look at the big picture. The compounded profit growth for last 10 years is 29%. Unfortunately, if you see, this is one stock where that despite the compounded profit growth of 29%, the last 10 years this stock has given only 12% return per year. Okay, maybe just matching the Nifty. Last 5 years, if you look at it, the compounded growth has come at profit to 77% and it has come at 14% here. And the last 3 years it has come at around 67% and this has come at 46%. So the last 3 years, of course, it has been an outperformer. And in the last 5 years, I would say inline performance with the overall equity index. And in 10 years also it is. But what's happening is at some stage in the 3 years period and all, you really get a big boom. So question is that at what rate you have to buy, when at what cycle level that you have to buy is very critical. Now 3 years back the stock was languishing, okay, very significantly, and in 5 years back we have to see where it was and look at the price at that point of time and the price to book value also at that time. So so 5 years back the price to book ratio was exactly 2, okay, and that now it has fallen to 1.2. So that is the reason, that is the profit growth was there very significantly, but 50% has been shaven as far as the price to book value is concerned. So that means you are buying when the 5 years median value profit to book value is 1.1 right now. That time when you are buying it was a 2. So that explains as to why the despite the growth, profit growth over 5 years, we have not been able to maintain this is because of the fall in the price to book value. Now assuming that you are buying at a profit now 3 years back, let us say it was in 22, right? So now 19 if you look at it, it was price to book value I would say 19 okay, October somewhere around, yeah, okay, it was all going at 0.6, 0.7. Okay, that has been one of the lowest. That explains why in the last 3 years it has grown up, because the profit growth has also gone up. At the same time, the book ratio also has doubled. So that is the reason why I got such a beautiful compounded growth. Now, if Tata Steel for some reason comes below 100, now it's 112, 113, then it will be coming closer to 1 book value. Okay, so you should start looking for some investment from that level. And the worst that could go from could be 75 or 70, because that also means 50% retracement from the top of 150 rupees which it reached. And second thing, price to book value can come closer to 0.7. Just imagine from 0.7 now it starts to pick up. Okay, even goes back to the median level, which is the median level, which is 1.1 in the last 5 years. Then you get a substantial profit in terms of the price to book value itself, in addition to the profit growth that you may get. And the last 10 years, if you see, the median price book value is 1, and that is where we are. So we should be now looking at this particular value for investment. So whenever you are investing at the price to book value of 1, then in that case we should see then where exactly we are looking. See, for example, the last since 2006 itself, the price to book value is 1.1. Okay, the price to book. So we are now closer to that. So that means when we are looking at the median level, and if you are averaging it out wherever it goes down to lower level, it becomes a fantastic place from where probably you get a very good growth. Now let us say the same thing as far as the prices are concerned. Since 2006, okay, this is 2005, and the price was 30, and right now it has become 105, 110. Okay, so the book value is almost the same. So all the remaining has come in terms of the profitability, in terms of the profit growth that we got, right? So even when we talk about the last 10 years which they are talking about, so we are talking about 2012. Okay, so 2012 also from here, the last 10 years, when we see the profit growth, we saw about is around this 15, I think now it's 44 and 113. So it's almost 3 times. So it is almost let's say whether it matches the okay, 10 years 29%, and stock price is managed at around 12%. Okay, and 5 years 77% and 14%, because this was 5 years. I clearly explained to you that we bought at a very high price to book value. And 10 years back also, if you had bought, because this 29 to 12 has gone, mainly because at that point of time, exactly at that point of time in 2012, we might have bought at a higher price to book value. Now we have seen only the price here, right? So the price that we have seen here, okay, that is in 2012. Let us say it was October, it was around 40 rupees, and it has gone in the present level. So October, we will look at the price to book value, October 2012. So not much. I think probably the price to book value also was closer to this present value only. So not much of a difference. So whatever that we got right now from 38 rupees to 113 rupees, which is approximately how much? 113 minus 38 divided by 38. It is approximately 100%, right? So 97%. 38, 113 minus 38 divided by 38. So we are getting something closer to that 11 to 12% on an annual growth. 2012 to 2022, the rise is from 38, it has increased to 113, which is approximately 3 times, right? So 3 times it has grown, and that means it is around 200% growth is there. But because of the CAGR, then in that case it will come closer to 13 to 14% growth. So if you buy at a price to book value of this, and the company normally grows over a period of 5 years and 10 years at a growth rate which is approximately where we got it, I think these are all matured companies, so we can expect the same thing to happen over a period of time. So in the 10 years, the profit growth has come closer to 29 to 30%, and the stock price has grown by 12 to 13%. So if we expect that this to be maintained, that 29 to 30%, because it has seen all the cycles, then we are sure that if you are buying at a price to book value which is closer to 1.1, we are sure to get around 12 to 13%. In case if we get something low, because the median is 1.1, there is a chance that we may get 0.7, 0.8. We got it couple of days back, around 80, 85 rupees. We got around 80 rupees or so, right? So the 80 rupees will represent something like 0.9. So in case if it starts to go down because of the increase in interest rates, and it comes closer to the 75 to 80 from 113, I don't know whether it will come, but I'm saying that you can start averaging it out below one book value, which essentially could mean that over a period of time you are likely to get 14-15%. In the shorter period of time, there is a chance that if things turn around again for commodities at some stage, and in that case it can be a full-blown rally to the extent of 35 to 40% per annum also. So a stock which is giving a return which is closer to the Nifty, not letting you off much from the Nifty levels, but at the same time has the potential to really outclass Nifty if things turn good. That is a summary for Tata Steel. So we have highlighted that how ICICI and Tata Steel, Reliance and all, when we evaluate both from price to book value, and also we evaluated from the PE ratio for Reliance and Tata Steel. We have also tried to look at the PE ratio from the angle of the interest rate as far as the global situation is concerned, and we have also looked at the Indian situation, trying to normalize the situation with respect to the US market. So going by all those things, it looks that a PE ratio of 20 or slightly below 20 can be justified in terms of the present interest rates, and looks to be a good level at which we can buy and then leave it for the EPS growth to happen. Now, if the Indian economy is going to grow at around 6.5-7%, then definitely the profit growth, the sales growth will also be approximately 8 to 9% top line. Profit growth also could be around 10 to 12%, which can translate into something like 12% plus, which is what we want definitely from the Indian markets, which we will get over a period of time. Then you will look at something high beta or probably those things which can give much higher return in terms of the small and mid cap, or some sectors which can give a better return than Nifty over a period of time, which could give 15-18% if you invest in small and mid cap through an SIP. So those are strategies in order to beat the market. Okay. So thank you right now, and if you have any questions, please ask. Thank you. So thanks for your participation, and hope to see you again next week with some similar topic. Thank you very much.